Candlesticks are graphical representations of price movements in financial markets, commonly used in technical analysis. Each candlestick typically represents a specific time period. For example, 1 day, and consists of 4 main components: opening price, closing price, high price, and low price. Opening price, the price at which a financial instrument begins the time period. Closing price, the price at which a financial instrument concludes the time period. High price, the highest traded price during the time period. Low price, the lowest traded price during the time period. Candlesticks are visually displayed on candlestick charts, where each candlestick has a body and wicks, also known as shadows. The body represents the price range between the opening and closing prices, while the wicks extend above and below the body, indicating the high and low prices. Doji, a candlestick with nearly equal opening and closing prices, signaling indecision in the market. Bullish, engulfing, a bullish reversal pattern where a small bearish candle is followed by a larger bullish candle. Bearish, engulfing, a bearish reversal pattern where a small bullish candle is followed by a larger bearish candle. Hammer, a bullish reversal pattern with a small body and a long lower wick, indicating potential strength after a downtrend. Shooting star, a bearish reversal pattern with a small body and a long upper wick, suggesting weakness after an uptrend. These patterns are often used by traders to analyze price trends and make predictions about future market movements.